Hello, everybody. This is Bennett Tchaikovsky, and this is take number 3. Thank you, Zarina. This is Intermediate Accounting 17th edition video solution walkthrough for Keiso, Weingart, and Warfield, exercise 16-6. Textbook authors are Don Keiso, Jerry Weingart, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2023 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within are those of myself and not the authors of the textbook or of Wiley. So let's go ahead and have some fun. If you're on the 18th edition, this will be exercise 15-6. So let's come over here. January 1st, 2020. This is the third time I'm making this video, but I think I figured it out. So on January 1st, 2020, Gottlieb issued $4 million of 10-year 8% convertible debentures at 102. Interest is to be paid semi-annually on June 30th and December 31st. Each $1,000 debenture can be converted into 8 shares of Gottlieb Corporation $1,000 par value common stock after December 31st, 2021. On January 1st, 2022, 400,000 of debentures are converted into common stock, which is then selling at 110, where because we're using the book value method, we don't care about the share, what they're selling for. An additional 400,000 of debentures are converted on March 31st, 2022. The market price of the common stock is then 115. We don't care. Accrued interest on March 31st will be paid at the next interest date. Bond premium is amortized on a straight line basis. Let's go ahead and have some fun. First thing we need to go through and do is record the bond issuance. On 1/1/20, I'm getting cash. I'm crediting bonds payable. I'm crediting premium on bonds payable. Why am I crediting premium? When it says 102, that means it's selling at 102% of face value. Right? So what I'm going to do over here, the cash I receive is going to be 4 million times 1.02. And my difference over here is going to be to the premium on bond payable to record bond issuance. So over here, I'm going to be going through, I'm going to have bond payable and premium on bond payable. My bond payable is going to be at 400,000 for 4 million. My premium on bond payable is going to be at 80,000. This is going to be at 1/1/20, and over here for the same date. Now, what I need to go through and do is that these conversions are not happening until January 1st of 2022. So I have to go through and basically pay the interest. Let's go figure that out. So every 6 months, meaning 6/30/20, 12/31/20, 6/30/21, and then 12/31/21, I'm going to be going through and making the same exact entry, right? And basically what that entry is going to be is to record interest expense. If I'm in a premium situation, right? My goal is by the time the bond matures, I need to make the premium go to 0. So that means I'm going to need to debit the premium on bonds payable. I'm going to go over here and record credit cash because I'm paying for interest, and then I'm going to have interest expense. When we are using straight line amortization of the premium, basically we're going to be doing the same amount every single time. So coming over here, the amount of cash I'm going to be going through and paying, it is a $4 million bond. Okay, the interest rate is at 8%, right? However, whenever you see an interest rate, it is always an annual rate, even if it says semi-annual. So my annual interest is $320,000. However, every 6 months, I'm going to be going through and paying $160,000. Okay. So over here, cash paid for interest is going to be $160. Now, when I'm amortizing the premium straight line, right? So over here, bond premium is amortized on a straight line basis. So I'm taking my premium, and I need to divide this by the number of times the interest is being paid. The number of times the interest is being paid, it is a 10-year bond. It's being paid twice per year. So this is going to be at 20, right? 10 years times 2, semi-annual. So the amount of the premium amortization is going to be $4,000. Okay. Now, this is very important. Okay, so over here. Okay. Now, the way we're going to want to do this, and this is really important, this is why I'm making this video for the third time. It finally took me this amount of time to go through and figure this out. The ratio of these different parts over here, or the amount of the premium to the total amount of cash being paid, is basically at 2.5%. The interest expense is also going to be at 97.5%. This is going to be very, very, very important for us. So let's just go through and think about this, right? So every single 6 months for the first 6 months of the bond, I'm making these interest payments, right? Nothing has been converted yet. So I'm going to come over here and basically say I've got the amount of the premium that is being amortized, 4,000 on 6/30/20. It's going to be another 4,000. So the total amount of my premium on bonds payable, this is going to be 16,000, or a total over here of 64,000. And this is my balance as of 12/31/21. So we've done the journal entry as of December 31st, 21, but it's very, very important that when you do these questions, you want to write the T accounts. If you don't write the T accounts, especially in these questions, you're screwed. So that's a nice way of putting it. You're in bad shape. Let's go to January 1st, 2022. 400,000 of the debentures are converted into common stock. So when I'm looking at this, right, so 400,000, or roughly 10% of the bonds are being converted. So over here on 1/1/22, basically 10% of my bonds are being converted. How am I getting 10%? Well, over here, 400,000 of bonds are being converted. My total amount of my bonds that I have are 4 million. So what that basically means is that 10% of my bonds are being converted. Okay, so coming over here, when I convert bonds, it means they're no longer going to be outstanding. So I'm going to debit bonds payable for 400,000. And I also need to debit the premium on bonds payable, because this is no longer going to be on my books. The amount of the premium that I'm going to go through and take off my books is going to be 10% of this amount. So this is going to be on 1/1/22. Okay, so we're taking those off of our books. When we take them off of our books, these are being converted into shares of common stock. So over here, I'm going to have common stock at par. Now, in terms of the bonds that are being converted, it says that each $1,000 debenture can be converted into 8 shares of Gottlieb Corporation common stock. So over here, if I have a total 400,000 shares, or excuse me, 400,000 of bonds, the debenture is basically 1,000. So what I'm going to have here is basically 400 bonds that are being converted. Okay. So of the 400 bonds that are going through and being converted, right, each one is going to be convertible into 8 shares of common stock. So the total number of shares being issued It'll be 3,200. Now, I want you to notice something here. The par value of this is $100, and I shouldn't even be doing this question because of that. But if you can find me a publicly traded company other than Berkshire Hathaway that has a par value more than $10 per share, come and find me, and I would love to hear from you. So that's my little challenge. So we've got 3,200 shares of common stock at 100 per share, or a total of 320,000. Over here, crediting additional paid-in capital common stock, which is going to be my plug or my balancing to record bond conversion. Okay, so we're looking good so far. Let's now go to the second phase of this. So now I've gone through, I now have, after this bond was being converted, I now have 3.6 million of bonds that are going to be outstanding. I also now have over here too, in terms of my premium on bonds payable, I have 57,600 of a premium outstanding. And this is basically as of 1/1/22 after the bonds have been converted. Now over here, it's telling me that I have another 400,000 of bonds that are being converted on March 31st. Now, why this is different? We are in between interest dates of the bonds. So what I need to do first is I need to go through and record basically the interest on these bonds, basically up until the date of the conversion. And you'll see why I do this momentarily. So when a bond is being converted in between periods, the first step I like to do is to record the interest for the bonds up until conversion. Now, when a bond is being issued in between periods, notice over here, it says bond premium is amortized and accrued interest at March 31st will be paid on the next interest date. So what we're going to go through and do first is we're going to accrue this interest that's being on this new bond that's being converted on 3/31/22. We're going to go through and accrue that interest first. So the way I want you to think about this, and this is why I went through and did this first. If we're converting 400,000 of bonds, right? So we've got 400,000 of bonds. The annual interest rate is at 8%. So we've got 32,000. So the amount of cash that would be paid for these bonds, right? This is annual. We're converting it on March 31st. So I'm going to multiply this value here by 3/12. Right? So basically this is bonds 3/31 conversion, annual interest rate, annual interest, and then basically 1/1/22 to 3/31/22, or 3 months. I'm going to multiply this by 3/12, so I'm going to get a total of 8,000. So over here, my interest payable, right? I'm not paying cash, but my interest payable is going to be $8,000. Now, the other two components are going to be the premium on bond payable and then my interest expense. Now, since we're going through and amortizing these things straight line, this should have the same relationship. So what I'm going to do is I'm going to take 8,000 and multiply it by the ratio. I'm going to take the 8,000 and multiply it by the ratio. What are these ratios? When I went through and did this part over here, I said, well, the ratio to the premium to the total amount of cash being paid is 2.5%. The rate of interest expense to the total cash being paid is 97.5%. So over here, I need to go through and basically show the premium on the bond payable for the converted bonds being over here at 200, right? So this is what I'm going through and doing, right? But if I'm doing it for this, I also have to do it for the remaining bonds, right? So the remaining bonds during this period of time, meaning from 1/1/22 to 3/31/22, the remaining bonds, if this is what was being converted, the remaining bonds over here are going to be roughly 3.2 million, or the 3.6 million that were outstanding minus the 400,000 are being converted, or the rest of the bonds. The reason why we have to do this is the next step I'm going to go through and do over here. When I get to 3/31/22, I know that I'm going to have to go through and convert these 400,000 of bonds, but I also need to go over here and do the premium on the bond payable. When I do the premium on the bond payable, this is going to be in a ratio of, basically, this is going to be 400,000 at the total number of bonds that I have outstanding, or 3.6 million. So I'm converting about 11.11% of the bonds that are outstanding. In order for me to go through and to write off or basically take out the proper amount of the premium, I need to go through and figure out, well, on the rest of this, how much of the premium did I amortize during this period? So over here, this is basically going to be at 8%. Total amount was 256. Coming over here at 3/12 for the same period of time, the amount of cash that was basically going to go through and be paid is over here at 64,000. Now, the amount of the premium on the other bonds, right? So this is going to be over here. This is the premium on the 400,000. Right? This is going to be over here on the 3.2 million, meaning that the other bonds that are not being converted, this is going to be, if this is the amount of cash paid for interest, or what I would be going through and paying for this time period, this is going to be 2.5%, or, right, the amount of the bond, basically the amount of the premium amortization times over here, basically this value here, or roughly 1,600. So why did I do this? Because when we go through and convert the bonds, right, when we're converting it, I had to amortize the premium on the bonds that are being converted to record the interest payable. But at the same time, if I'm going to employ a similar method, right, remember what I did up here. I said, well, we had 400,000 of bonds being converted. This represented 10% of all the bonds. Now we're doing another 400,000, which is now 11.11% of all the bonds. So in order for me to do this properly, what I need to go through and figure out is, what is my premium in total prior to adjustment? So over here, what I'm going to go through and do is I'm going to take 55,800, which is my premium, like hypothetical premium, if I was going through and doing this, times the 11.11%, or roughly 6,200. So again, what am I doing over here? So prior to any type of adjustment on 1/1/22, my premium on bonds payable was 57,600. When I am converting a bond mid-cycle, right? When I'm going through and converting a bond mid-cycle, I have to go through and amortize that premium accordingly. So we figured this out with the percentages, right? You're going to pay $8,000 at interest. We look at the relationship, right? It's 2.5 and 97. Apply that over here. That's great. But now I'm in a situation, though, whereas I'm sitting here going, okay, but what about those other bonds that didn't convert? How much was that premium? How much did that premium relate to it? Well, we basically said, well, if it was 3.2 million, 8% interest, so the cash being paid is 64,000. If I multiply that by 2.5%, I'm going to basically get 1,600. So I had to do this because now I'm saying that, okay, where is the 6,200 coming from? This is basically going to be 55,800 basically times 1.111 or 6,200. That's where this value is coming from. So coming over here, this is what I'm getting. Now, for the rest of this part over here, this is going to be relatively straightforward. I'm now going to have my common stock at par. The same number of shares are being converted. So this is going to be 400,000 at $1,000 each debenture times 8. So you're going to get 400. It's 400 times 8 is 3,200. So it's basically going to be the same one over here. The remaining amount is going to go to additional paid-in capital common stock. And this is going to be 400,000 plus 6,200 minus 320 or 86,200. It's basically a plug, or what am I balancing entry to record bond conversion? Okay. So the last part here is now I'm going to go through and pay interest, right? So on 6/30/22, I now have to go through and pay bond interest. When I go through and pay bond interest, what I have to remember is over here, I recorded this interest payable amount of 8,000, right? This related to the bonds that were being converted. But what I now need to go through and do is say, okay, how much am I going to be paying on the remaining bonds that are outstanding for the entire time? Well, the bonds that were outstanding, right, I already took care of this 400, but the remaining 3.2 million. So this is 3.2 million. This is the remaining bonds outstanding, right? These were outstanding for the entire time. So we've got 0.08. So this is the annual interest. I then need to multiply this by 6/12 because this was outstanding from 1/1/22 to 3/31 to 6/30/22. So this is going to be 256 times 0.5 or 128,000. So my cash being paid out, I got that wrong. This is basically for the bonds that were outstanding. But so my cash paid for interest, right? So my cash paid for interest right over here is 128,000, and this is on the 3.2 million. However, the total amount of cash being paid, so 3.2 million cash paid for interest. However, the total amount of cash I'm going to be paying out is this amount of the interest I accrued. So over here, the cash being paid is going to be 136,000. Now, I've got this part down. So my cash paid for interest is going to be the 128 plus the 130 plus the 8,000 that I accrued for a total of 136,000. However, I have a problem, right? So I got to balance my entry. So I'm going to have over here premium on bond payable. I'm also going to have interest expense. My premium on bond payable, if I'm following the same logic, is not going to be 2.5 times 136. Why not? Because I already did that calculation up here. So this is going to be 2.5% times right over here, the 128,000, which is the 3.2 million of bonds outstanding. Okay. So right over here, this is going to be 128,000 times 2.5% or 3,200. The remaining amount is going to be going to my interest expense, or 128,000 times 97.5 or 124.8. If I add all of these up together, I get the 136 going through. If I wanted to go through and to check my work, I can go through and do so, right? So this is to record interest expense. The way I would go through and check my work to make sure that it was correct for the remaining amount of the time. So on 6/30/22, I amortize this for another 1,600 because I already have this up here. So now over here, as of, by the way, this is in two parts. The 3,200, half is coming from before, half is coming from this part over here. So my new amount of my, basically my new amount of my unamortized premium is going to be 54,200. To check my work, right? This is going to be the amount of the premium that's going to be amortized over the remaining payments of the bond. This is a 20 payment bond deal, right? Through June 30th, 2022, I have made 5 payments, right? So I've made 5 payments, right? I made a payment over here for interest on June 30th, 2020, 12/31/20, 6/30/21, 12/31/21, and then 6/30/22. So I've made 5 payments. It means I have 15 payments left. If I've done this correctly, right, the amount that I'm now going through and amortizing is the premium times the 15 left, and I'm off. Wondering why I'm off. But I think it's close enough. Let me take a look at my solution. Just give me a moment. So one of the things I wanted to kind of go through and do was just to kind of go through like and check our work and just to make sure that what the solution we just came up with looked right. And it actually does. If we want to kind of go through and trace back the premium we've got over here. So what I've just shown you right now is what Wiley has in their solution. But let's just kind of go through this and talk about this anyway. So we had an initial premium on bonds payable of 80,000. And we had our first 4 amortizations of 4,000 each. We had our first conversion. We had our second conversion over here. We had basically our conversion for the second bond was 6,200. We had the interim of 200. And then for the 5th payment, we had a total of 3,200. So essentially through this point in time, we would have had a total of basically 48,000 total. And I think when I was going through and doing this, that's where I may have gone through and messed up. I know where I messed up now. I didn't put in the conversion basically over here for the write-off, right? Or basically for the bond that went through and was being the second bond that was basically going through and being converted. That's where I screwed up on this. So just in terms of going through and like checking our work. So this part over here, hold on. So where I screwed up in terms of doing this solution was that this should have been hold on. Okay, so now if we do this, okay, and then yeah, and then if we go through and look at it here, right? So if I do the 2 conversions, then you've got 48 grand left, and by the end of this is going to amortize down to 0. So this actually goes through and works. So my main advice to you, if you get something like this, the first thing I would go through and do is make sure you're using T accounts. The second thing you also want to go through and do too is use this percentage, because if it's straight line, it's really going to save you. This is my 3rd attempt at making this video, and I can tell you the other 2 times this is what was messing me up. But once I basically said that this was, it's a percentage, it was a lot easier to go through and compute. So with that all being said, I want to thank Wiley for allowing me to share this with you over here today. If you're looking for other solutions, please feel free to ask me for them in the comments. Thank you for liking and subscribing, and I look forward to seeing you on the next video. Have a great day.